From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning and welcome to the Macrocast. It is Friday, August 7th. It's non-farm payrolls day, our favorite day of the month. We have my partner, Matt McDonald from Hamilton Place Strategies with us. I'm coming to you from an hour east of Pittsburgh. Matt is in Washington, D.C. Our partners at Markets Policy Partners are with us too. Brendan Walsh, who I think you're still up in Cape Cod, Brendan, and John Fagan in the DC area as well. Still, John?
That is correct. Yeah, but hopefully plotting our escape. We'll see.
Good, good. So we had jobs this morning, and you know what? It was one thing I'll say about the jobs. We'll get in. Matt will take us through the numbers, and but one thing that is like a little bit heartwarming is like expectations are getting closer to reality. We had like wild, forecasts early where, like all of us just basically had the shrug emoji, whenever we saw the numbers. But now at least expectations are getting closer. So maybe the modeling is getting a little bit better. That said, I guess it was a slight beat on the numbers. Expectations were not high though. Matt, what do the numbers say?
Yeah, I think that's right, Tony. People were I saw numbers kind of in the mid 1 millions, 1.5-ish, 1.4-ish. We got total non-farm payroll rose by 1.8 million. The unemployment rate fell to 10.2%. So just to kind of put that in perspective, our trough, which was in the numbers, which was generally, I think, around May for most of it, from peak to trough over the course of kind of the, I guess that'd be the second quarter, we lost close to 25 million jobs. And from trough to where we are now, we've gained back almost 10 million jobs. So we are, the economy has kind of the jobs that were lost, and again, we're at 10% unemployment. We've gained back about 40% of the jobs that were initially lost. So we're not, read that as you will. 1.8 million new jobs in a month in Earth 2.0 is great, but we're not even halfway back to where we were before this. A little bit more on some of the particulars behind the numbers. Unemployment rates declined for almost all the major working groups except for Black Americans, which showed little change. The temporary layoff designation, which has been a quirk of this economic period and how BLS is looking at the numbers, that decreased by 1.3 million. Some of the industry highlights are interesting too. I ran some quick numbers this morning, and you have kind of education and health industries, which are bucketed together. Those have seen a 40% return since the trough, which is about in line with overall. And then on the positive side, leisure and hospitality has gained back about half of their jobs. I think if you broke that down by which have gained it back, that's probably highly variable depending on the sector, the company, et cetera. And then construction is actually 60% back. They actually didn't have, it's interesting, when you think about how people are picturing the economy, V-shaped, L-shaped, et cetera, et cetera. I think different industries are at different points in that recovery, right? So like you're going to, as jobs return, there's going to be some diminishing return. Like it's going to pop in the beginning and then it's going to be a little less and then a little less. Construction, I find interesting in that they've gained back 60% of their jobs, but in July, employment only increased by 20,000 versus say leisure and hospitality increased by 592,000. So I think you're seeing different industries that are at different, different parts of the return to work cycle. And some of them, I would say that like construction for me is a little bit of a red flag of like, okay, they got 60% back, but it feels like it's stalling out a little bit. And there's a lot of, these are seasonally adjusted and what have you, but if I were trying to read tea leaves, which is what a lot of this feels like sometimes, that's something that I would be paying attention to.
We saw, but participation was around 61.5, somewhere in that range, I think.
That's a little troubling because it was 61.5, and then it went down to 61.4.
Yeah.
So it looks like even with these people coming back into the labor force, the size of the labor force increased more. So that was one of the little more troubling. When I look at this, I see a reality that the stimulus that we did worked. It was able to provide a bridge for a lot of these companies. Because as Matt said, a lot of the hiring this one was, retail stores that were not essential, bars, restaurants. So they were the phase 3 people that were allowed to reopen. So it wasn't new jobs. It was people that lost their job and then it reopened. That was great. But we also have to keep in mind, this was a point in time, and that point in time was mid-July. The world has changed a lot, even in a month. And from all the real-time data we're seeing, phase 3 reopenings didn't go that great. When people go into bars, infection rates go up. When people go into inside in restaurants and also, are shopping around malls and things like that, that's how the virus spread. So a lot of that has pulled back in terms of the real-time spending. John Dick told us that last week. Mm-hmm. So August numbers might not look quite as good as July numbers, especially because this wasn't new hires. This was you're going back to work. So this brings up a point where we need more stimulus, and it looks like from DC, the negotiations are falling apart, and today is kind of the D-Day, right?
We'll get into phase 4 or whatever we call this, but I don't know, whatever here's 2, phase 4, heels 1, whatever. Yeah, but we'll get into that. But let's because you're right, and that's going to have a huge impact both on where the consumer is, for a lot of these businesses. But let's just stick with non-farm payrolls for just a little bit longer. And so we saw what did earnings say? I mean, so people who were coming back, was there an uptick in earnings? On hourly earnings, I think I saw a modest increase in hourly earnings. I don't know if does that mean anything right now? I mean, I don't know how to tease that out.
Yeah, because you have the numerator denominator problem where so many of the jobs are lower wage and they're out of the calculation. So things definitely get screwed up a little bit when you're talking about the hourly earnings.
Yeah, that's right. We saw that a lot in the early parts of this.
Yeah.
I mean,
so as the lower wages come back into it, which is what this hiring was, it actually can drive down the overall number.
Yeah, I mean, basically, when you think about the part of the employment cycle that we're in, is that this is the sticky wage part and the change in jobs part, right? Yeah. We just came out of the phase. I mean, we were tracking and looking at wage increases as an indicator of economic strength, because as the labor market tightens, you want to see the wages go up. But when the labor market is super loose, you get what you get and you don't get upset. So the wages become just kind of like, there's not a ton of negotiation going on. Employers typically you're not going to see, not to tangent off on this thing, but it is interesting in that, like, in theory, what we could do in an economic contraction, or what employers could do, is give a haircut to everybody on pay, right? And that's one way to like adjust, but they don't, because wages are sticky and people don't get pay cuts. So instead they cut jobs, right? so that's what we see in this part of the cycle is jobs go down and then jobs go up, and then eventually we get to pay increases. But
yeah, in this country,
to say it's not a metric that I am tracking closely right now.
Yeah, but some other countries do, do that, and I mean, this was, and this is basically, Keynes's point, right? Is that, is that we never cut wages, and but we don't cut wages, we cut jobs. But some other countries actually do that. They actually do, they will adjust on, prices rather than quantities.
I should caveat that by saying typically, like, the top end of lots of companies, high end wage earners, do have a component of their compensation that is highly incentive based, right? So like I worked for Governor Schwarzenegger for a period of time, and California is a really interesting case in this, where like California has a fairly high dependency on income taxes. And that's why California for decades has had these wild budget swings where they go from like surplus to deficit to surplus to deficit, because they're so dependent on high income earners whose incomes do actually go down during periods of crisis, and then their tax base gets hit as a result.
I remember David Tepper lived in New Jersey, so he ran a huge hedge fund, and then he's now the owner of the Carolina Panthers. So a few years ago, he moved to Florida, and because he moved, New Jersey had to redo their budget because they had a $300 million hole.
Amazing. Yeah.
Well, speaking of the markets, we've seen, the reaction to non-farm payrolls in financial markets. There was a sense of caution coming into it. We'd seen some nuanced data earlier in the week. The ADP compiled private payrolls, which came out earlier this week, was a considerable disappointment, still in positive territory, but only 167,000 workers added by their metric, versus which was far short of market expectations, which were about for 1.5 million after the 4.3 in June. We saw some improvement in the weekly jobless claims. It was 1.2 million Americans filed for unemployment benefits in the week last week, but that's down from the prior week by 200,000, but still the 20th straight week above a million. And so there was a little bit of because we got these mixed signals earlier in the week. There was a little bit of trepidation, and what we've seen in financial markets, actually, some of the signals really got garbled because just after the non-farm payrolls came out, headlines broke. The Trump administration is planning to put sanctions on Hong Kong Chief Executive Carrie Lam as early as Friday, and so that sense of U.S.-China tensions skewed market reactions here a little bit to the risk-off side. But coming into it, 10-year Treasury, longer-dated Treasury yields were absolutely flat on their backs, down by early March lows. The yield curve, the Treasury yield curve, has been steamrolled by the Fed. Again, relative on the index level, pretty insensitive to economic data and fundamentals because it's so tech-heavy, so tech-led, and Google, Facebook, Amazon, Netflix just don't react to data points like non-farm payrolls the way that the traditional economy stocks do. And so it's really been the dollar that's been kind of the swing factor. It's been currency markets that have been reflecting these data points. And the dollar got a little bit of a boost. It had been languishing down at on a broad dollar index around 2-year lows, got a little bit of a boost on the back of the better than expected non-farm payrolls, and is now strengthening considerably in this sort of risk-off environment as the U.S. gets more confrontational against China. So it's really been a pretty narrow field for market participants to really express their reactions to these kind of numbers.
Did anybody react? Was there any reaction at all to President Trump apparently pulling out the tariff stick again? It's kind of like an oldie but goodie. We haven't had tariffs slapped on our trading partners and friendly neighbors to the north in a while, but he's talking about imposing 10% tariffs on Canadian aluminum again. Was there any reaction on that, Sean?
Let me take a peek at the markets here. But in broad market terms, there really wasn't much of a blip. Sort of punishing Canada is relatively limited in terms of the adventures of Tariff Man. Tariffing Canadian aluminum isn't necessarily the best seller in that series. And we've seen aluminum prices basically going up. Now, it's not a big surprise. If you put tariffs on, it can be supportive, but that's just an accelerant to the upside trend we've seen in aluminum. And that really has been across the board when you look at industrial metals. And it's not just expressing these snapbacks in copper and aluminum and other industrial metals, not just reflective of an economic and manufacturing comeback around the world and China in particular, but also of the weaker dollar. These metals obviously get a lift when the currency that they're priced in has been falling. So it does that sort of counterbalance effect.
Yeah. All right. All right. Good jobs report. Why don't we? One thing that will impact jobs and will impact demand, as Brendan was noting, is the talks for continued stimulus. Why don't we take a break here and come back and dive into where things stand with those negotiations? You're listening to the Macrocast.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
Okay, we're back on the Macrocast. We've got ongoing negotiations today on whether we're going to get a next stimulus package. It could happen today. Could extend into next week if they agree to some parameters and maybe a deadline. It's at this moment on Friday morning, it's looking unlikely that they're going to get to some kind of agreement today. But the day is long, and you never know. And you've got President Trump threatening to use executive orders to try to get a deal done. Just a note on the executive orders he's promising to use is to try, an executive order to try to extend foreclosure, a moratorium on mortgage foreclosures, on student loan relief, on unemployment insurance, and to impose a payroll tax cut. And I'll just say, I kind of get the White House's interest in trying to be dynamic and trying to shake things up on this. To me, I don't see how it helps, shake loose a deal. I think if you're Nancy Pelosi and you're looking at that threat, you say, well, it's not sure that he can do anything at all on unemployment insurance. It's not clear where.
Yeah,
the law
I was going to
is.
ask you about that.
Yeah,
isn't that power of the purse a constitutional thing?
Exactly. So it's not. It doesn't see how he can actually do anything with that. He can do payroll tax cut, except like Republicans hate it.
But I also read it's not a cut. He can only delay it.
He can only delay collections, right? So companies aren't going to pass that on. They're have to hold it. So
it's really just a hassle for you.
It's due, right? It's just a hassle. On student loan relief and foreclosure, and extended foreclosure moratorium. Those are things that Democrats want.
Right.
So Democrats just pocket those. Say, thank you very much. Now let's go back to negotiations on the things that you're going to have to give up something else now to give us other things that we want. And those things where
stop
it's really
throwing candy at me.
Right. Exactly. So where it's breaking down is, on money for states, which Democrats want, and liability protection, which Mitch McConnell has said is a red line for him. He will not bring a bill to the floor without liability protection. Look, I think
he stands to that.
I think he has to. I think
it's a really important point.
Back down. Yeah, I've never seen him back down on something like that. And
liability protection is one of those things that every business and board is talking about and does not exist in kind of the public discussion in a material way.
Yeah,
not at all.
I think that's the part that the popular narrative is missing. I think on a lot of the spending thing, you can just, cut it down the middle. Even on the state, it looks like the Republicans are fine with the, 180, 200 billion. But liability, it's those are differences between two parties.
I think they're going to get it. Look, I think they're going to get a deal. I don't think it comes today, though. I think this is going to go on for a little bit. I mean, my view on this, especially in Washington, whenever I talk to people in New York, they're like, This is stupid. Split the difference. They're asking for 3 trillion. Republicans are asking for 1 trillion. Whatever. Liability protection. Yeah, a little bit of state aid. There's your deal. Go home and go run to election. What are you guys doing? And one thing that always needs to happen, which is because these are public negotiations, unlike private negotiations, you can give and take, and it's not where you've given and where you're taking isn't clear to a lot of people until the final package is delivered. Here, these pieces are being negotiated in public, and you cannot be seen to cave on a priority of yours until it's the very last moment, and all the pain has been absorbed for it, right? Like, pain needs to happen, and then blame needs to happen, and then you can start cutting differences. And I don't think we don't have enough pain yet, and we haven't established the blame yet, but we'll get there.
I have a great story on that.
Yeah,
so in business school, I had a class with Jack Welch, right? And during class, there was a GM strike that was on, right? And Jack was basically like, you know that this is all just show. Like, they've already done a deal. And the union leaders have called the strike to show their constituents that they went as far as they possibly could. And then the strike's gonna be over in a couple days, and they're gonna sign the deal that's already been agreed to, and it's all done. And to your point, Tony, is that, like, watching public negotiations there is a performative aspect of it that is super important.
Yeah, it is. And by the way, it is important, right? I know it looks like ugly and painful and too stupid, but it is important, right? Like, if you're gonna cave on a principle, or you're gonna cave on a priority, like you have to at least show that you're fighting.
I just want to point out that, like, the business world does this too. This is not exclusively the realm of crazy politicians.
That's true.
But in DC is a very process-oriented town. It's the process that is, maybe the results aren't always secondary necessarily to the process, but it is it's very important to everybody has to get around the table. It has to be the right the right way to go forward, and that's a very DC thing.
I do think they're going to get, like, those elements, by the way. I mean, I think there will be some, state money in here. The question is, how much are Republicans willing to pay for liability protection? This is a pricing, because they don't believe that states need any money at all. And so this is a very small market here, and they're going to pay. They're going to pay in state aid dollars a price for liability protection for businesses, and I think that's where this is going to come out. And I think, again, like I said this before, I think Nancy Pelosi, we could argue whether she does or doesn't, whether it will be popular or not be popular, but I think she believes she has the whip hand in these negotiations.
The interesting, just not to leave the process, but to talk about the substance on liability for a second, is that it is fascinating that I think that one of the reasons that liability protection from a material aspect is so important is because the government and public health guidance knowledge and on the pandemic and what to do about it and how to address it has been so bad.
Such a great point.
Is that, like, businesses are held to a standard, and when the standard is moving all over the map because of government has some obligation to provide relief to that particular problem which they are causing. And, like, there's a dimension of, sure, there's, like, the trial lawyers want to sue and business doesn't want to get sued, but, like, government is an active participant in this problem, and they are a creator of this problem. And so, like, I don't think that I do think that this is a little different than some other places where you get typical fights between Republicans and Democrats on, like, suing.
And you two actually have a really interesting perspective on that, because you're seeing it from both sides. You know what it was like to be on the government side, but now you run a business. And when would you feel safe to bring
But
people
especially,
back?
and that's right. That's exactly right. And I mean, obviously, especially with retail businesses. But to Matt's point, like the guidance has been all over the place. Wear masks, don't wear masks. Here are the guidelines for reopening. Well, like they're just guidelines.
Yeah,
We've seen
just changed their guidepost for phase 3.
Right.
They it's not even, I mean, that's kind of crazy. It's like, okay, phase 3 went from like 10% positive tests to 5% positive tests. It's like, okay, well, what is that? That is literally moving the goalposts, and like, it might be the right decision, but then to kind of hold people who are trying to follow this guidance liable for that is crazy.
Yeah, it's bonkers.
And I mean, doing for our business, it hasn't been. Yeah. For our business, it hasn't been a big deal because, like, I don't think that there's an impact on working remotely, but not like a retail store, not like a restaurant, not like a school where the fights are now on some of this stuff. So it's a little different for us, but those conversations are real.
Hey, we get nerdy on. Oh no, go ahead.
And when it comes to the timeline, it certainly seems as though today's self-imposed deadline, as you say, Tony, looks like it may come and go. But over the weekend, and Mitch McConnell has said that he's going to keep the Senate in session. And there's clearly, a lot of market participants in circumstances like these harken back to the TARP motif, which is if you vote it down or if the deal fails, then the market reaction is adverse enough that the parties in Washington, D.C. do an immediate U-turn, go back to the table.
I just wonder if markets will, even if they walk out, whether market reaction will do that, and because I still think they've seen this act before, and because the Fed still has its foot on the pedal, fully on the pedal. One thing I want to get at, and John, and ask you on this also, is one other thing we saw this week was Treasury's quarterly refunding announcement, which is they laid out their borrowing plans going forward, which were interesting, right? It's like, I mean, signaling just how much they're going to be borrowing over coming quarters, just huge, a couple $1 trillion for I think the rest of the year. And but what was interesting to me was on some of the notes on some of the chart presentation was their concern over the average maturity of Treasury. So there'll be a big reliance on T-bills, and the average maturity of the debt has gone down quite considerably. So we've been financing a lot of this on the shorter end of the yield curve, and so they're going to have an intention to extend that out a little bit. So, but there's this question of rollover risk on the debt, right? I mean, this is they need to deal with this.
I mean, sure, the Treasury would never say that there really is any appreciable rollover risk. They express, as you know, the outward facing messaging from Treasury is always, we have ultimate and 100%.
And they do. As two Treasury guys here, of course they do. Of course they do. The question is, at what price?
And I think the actions speak louder than words. We saw the refunding announcement come out, and it was much more aggressive in terms of putting the supply further out into the longer dated maturities, 10, 20, 30. Those were much larger increases than in the front end. This was something that took market participants a little bit by surprise. This came at a time when the longer dated part of the Treasury yield curve was really, lounging and relaxing back at very low levels, extremely low volatility out there, and had slid back. The 10-year yield was just above 50 basis points back towards its early March lows, and just reclining. And when this news hit, there was obviously a knee-jerk reaction, but as the day played out, it really didn't end up moving yields that much. And I think that ends up I think the 10-year Treasury yield was up like 4 basis points. That's big compared to, its overall level, but from 50 to 54 basis points or 51 to 55 basis points, that's definitely a win for the Treasury Department. If they can put that kind of supply further out the curve and not see a big reaction, whether it's down to Fed purchases or whether it's down to what other dynamics, that is something that I'm sure they're very encouraged to see.
Just a little fun fact is that like a 10-year, right, that comes up in 2030, that will be when the baby bust from the financial crisis is about 22 and entering into like prime years of starting into the workforce, and like the baby boomers have basically finished their cycle. So that'll be fun.
That'll be fun. Yeah.
And now we're having a new baby bust, right?
Yeah, exactly.
One other note on that before we break is I think they have they put a plug in for expected additional financing for for new stimulus of about $1 trillion. I think the longer these negotiations go on, that number may be closer to $2 trillion than $1 trillion. That's not an insignificant increase in additional financing. So they'll come back. I think the next quarterly refunding is it November?
Yeah, and this comes at a time when a report came out earlier this week that the Federal Reserve, and we've talked a little bit about this, their enhanced guidance where they link their interest rate policies more explicitly to some of their inflation targets or a full employment target. There is now a report that they're discussing doing the same thing with quantitative easing, linking quantitative easing and the volume of asset purchases, primarily treasuries, to these very same kind of benchmarks and targets. And that is, if that is part and parcel of their enhanced guidance, that is basically an overt admission by the Federal Reserve that they are going to be in the quantitative easing business for the long haul. And that is certainly, that dovetails with with the kind of volumes of supply that are coming into the Treasury markets. Having the Fed in there is awfully useful for keeping things on side, so to speak.
Yeah. That's not a good sign for actively managed equities, because even I could write an algorithm when you're supposed to buy or sell.
All right, hey, let's take our last break, and we'll be back on the Macrocast.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter @marketspolicy.
Okay, and we're back on the Macrocast. John, one thing we have overnight is the president taking aim at TikTok and WeChat. Where is this standing now? What's going on with these companies?
Yeah, this is the latest in the President Trump's 2020 motif of relatively high profile policy actions to counter China. Relative a broad, tough on China stance. This is something that he is obviously intent on bringing into the election, and by contrast, painting Joe Biden as soft on China. TikTok is something that really fits the motif of this set of actions against China. The Trump administration is obviously making pretty aggressive actions here, but seem to be respectful of these red lines that would tend to draw, or more likely to draw, a really furious reaction from Beijing. And so whether it's the phase one trade deal is one of those red lines. Tearing that up would for instance, would draw a very self-defeating and damaging market reaction, economic reaction. The Chinese would stop buying U.S. soybeans or something else that's quite aggressive. Something like TikTok fits pretty well because it's very hard for Beijing to retaliate since they block our social media apps already. And so it's one of these things where they can poke the dragon, but the dragon won't necessarily breathe fire on them in response.
It is fascinating, though. I mean, it's I think these next 45 days, looking at how these companies are, what happens with them. It's not clear to me what WeChat can do. Is there? I've not been paying attention to any idea that there was some idea of a shotgun marriage for WeChat. Wall Street, or I guess the New York Times, reporting this morning that, which I wasn't aware of, that there were other suitors besides Microsoft in the game for TikTok. I'm not sure whether that matters. I mean, 45 days or sooner of doing diligence and whether you can ever get a deal done is a pretty big question. And so still Microsoft might still be the best opportunity there. But it's going to be fascinating to see how that plays out. And if the line is that any Chinese companies that have access to personal identifiable information of Americans, if that becomes the standard, we could be at this for a long time, because there are a lot of kinds of companies that actually do collect personal data on you in very normal and routine kinds of ways. So we'll be keeping an eye on it. Brandon, what do we got next week for data?
So in Europe, the UK and the Eurozone are going to report their second quarter first cut at their GDP. We get the CPI in the US, and then the really big one is we get retail sales for July.
Yeah, it's good. The retail sales number, I think, is going to be. I never really paid that much to any one particular retail sales number, but now I'm paying closer attention to them because of just how much of retail sales are being supported by government transfers. Yeah.
And also within retail sales, the headline number is one thing, but the underlying details are fascinating with the way, consumers are changing their behavior because of the pandemic.
Yeah, I agree. All right, guys. Great job today, Macrocast. Have a terrific weekend. We'll be back next week.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.